Just looking at the current prices of the stock market, we can see the inevitable weakness that will present itself. Perhaps the market can be pushed up further. There's no telling how far it will go. But one thing is for certain, the central planners are deciding the fate of the global markets, and they know precisely when to let it fall to the floor. You came here for the truth, so let me unveil that for you. Today we're going to discuss something that remains to be an issue in the mainstream media. And I want to get into this chart right away by taking a look at this. What level on the S&P 500 do you think would cause the Fed to stop hiking rates? You don't often hear individuals talking about this. It's a little bit too frightening for some. But I know if you've been watching the Money GPS, you're willing to accept the truth. And that is the Federal Reserve controls the entire stock market, bond market, housing bubble, and everything else interconnected with that. They do so by printing money or drying up liquidity. They have a very simple task, and that is allowing this whole entire fraud to continue. It can happen for years. They can push it down the road for as long as they want. But take a look at the last cycle. They could have kept it alive throughout 2008, but they let it crash. In fact, major institutions needed to be bailed out in the process. You had failures at massive multi-billion-dollar levels. They could have prevented that from occurring, but instead, they let it fall. And they did so with a very specific intention, and that is more control, and that is more wealth for the globalist elite. That was their goal, and they achieved it. Now, you can't go all the way to the touchdown, to the end zone in one try. You have to do so in a series of steps. And they find that over the course of several years, you can acclimate the public into accepting the fate that has already been pre-decided and make them think that everything is a natural event, even while we know the actions of the Federal Reserve, of the central planners, a whole handful of them are made public. When they increase interest rates, when they decrease them, when they print money, when they dry up liquidity, when they use their forward guidance at their meetings. These are all public. Now, what they're doing behind the scenes, we don't know. We know that there has been a lot of money printed and given out that was not disclosed to the public. So we found some of that. So we know that it's going on behind the scenes. But on a day-to-day basis, we simply don't know. But even the information that we do have, we can determine the fact that what they're doing here today has a dramatic impact on what we see in the different markets. And a lot of these, this is a fund manager survey, and it basically said, what level in the S&P do you think would cause the Fed to stop hiking rates? And right now, as of October 2018, 2350 on the S&P is going to make the Fed, I was trying to not curse there for a moment, but essentially what we have is the Federal Reserve, at a certain point, they're going to realize, oops, or they're going to make it seem like they're going to say, oh no, what have we done? And usually, I could show you here if I pull out my pen, usually they're hiking rates in this manner, going up step by step, and then they get to this point at which, according to the fund managers, will be 2350. I'm not predicting that. Anyway, they get to this point, and then it trails on at that rate for a period of time. I've seen instances where it's a year long of the interest rate remaining the same. Maybe 6 months, maybe a little longer. Depends. And so we have this rate. In the meantime here, this is the recession. But they don't admit it until after. Then they understand the fact that it's fully understood, okay, we are in a recession now, oh my God, hurry up. And they start bringing down the rates. And they bring these rates down and down and down. And in the last recession, you saw them go down to 0. So this is what could happen again. Very well. They're suggesting 2350 on the S&P. I don't know. It depends on the issues that are happening at that time. We can't just say, based on a certain number on the S&P, that's going to make them react. I don't think so. But anyway, this is really what occurs. And I have to start to wonder about what the Federal Reserve's true intentions are. Because it's not to prop up the markets necessarily, because they do bring them down at some point. If it was to prop up the markets, you would just print quadrillions of dollars. So we know that's not their mandate. I do believe that it is to exact control over the population using the financial system. A lot of people don't want to believe that. But if you're a truth seeker, I assure you this is the information that you need to understand. And I know you do. US 10-year yields typically peak where the Fed funds rate peaks in a cycle. So there's going to be a convergence here. You can see I make the estimation that the Fed funds rate will probably not be able to get back to 3% without causing a problem. Does that mean that it can't get to 3% or 3.5% or even 4%? Of course it could, but I'm saying without a problem. And you could see that in these instances here, when we look at the previous hikes, the gray line, by the way, is the Fed funds rate. And then my crude drawing, this point here is a little bit, so 3% would be right about here. So it looks like a little bit under 3% where we'd have this convergence somewhere around 3%. That's why I always made this estimation of about 3%. I don't know what's going to happen. That's really what I think we should be paying attention to. Look at what the Federal Reserve's actions are, understand their policies, and look who benefits. Look who benefited in the last recession. The average person did not. The pension funds absolutely did not. The mutual funds probably did not. The hedge funds really haven't done that well. And you look at the institutional investors pulling out their money at this time, you know that they're starting to get worried that we're heading back into that previous cycle. What they're doing with their money, I don't know. They're probably not going to ever make really, really good decisions. That's why you see these major fund managers, they say they have trouble outperforming the market. And that's not within one cycle. That's over multiple cycles. So the average person feels very smart in a bull market. But if their stock portfolio decides to crash, will they be able to restore themselves afterwards? That's what we need to really look at. I'm going to end the video there. I'd like to know what you think about the Fed funds rate and where you see it stopping. Do you think that the Fed will act at a certain level on the S&P, or will it be multiple factors? Will it be trade issues? Will we have, some other issue that comes up, and what you think that would be? So I want you to share that in the comments below. I'm always interested to hear your comments, especially, when we get comments from people all over the world. That's so fantastic that we have that information out here. And that's all for this video. I just want to ask you, if you found it informative, to please give me a thumbs up. When you give me a thumbs up, you really support this channel. So I do appreciate that. And last but not least, if you want the financial education that was withheld from you in your school, in your regular education, well then these two books have everything you need to know. Everything from the foundation all the way to the asset classes and how to make money from it. You can get that in these two books. Check out the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.